Hello and welcome to a brand new edition of Inside Out on the Road, a show where we focus on individual stocks with in-depth analysis, deep dive into financials, and also tell you about the key risks and triggers going forward. Well, let's not waste any time and get straight to the first stock that we have for you. My colleague Sonal gets us this very special deep dive on SKF India.
Of SKF India, a multinational company that started its operations in India back in 1923. That's 100 years and a long time. If we track the last 10 years' performance, the stock is up 700%. It is a well-known bearings manufacturer and manufactures variety of bearings, be it automotive bearings, industrial bearings, there's mounted bearings and housing. There are seals as well, industrial seals, automotive seals. They also do test and measuring equipment and vehicle aftermarket as well, and caters to a variety of segments. In the automotive segment, it is the two-wheelers, commercial vehicles. In the industrial segment, it's marine, aerospace. They also cater to agriculture, there's textiles. They also cater to sectors like pulp and paper. There is something like wind energy, oil and gas, railways as well. This is something that they do around 6 manufacturing facilities with 450 plus distributors. In terms of financials, the company has done well in 9 months. Revenues at the 9-month mark are 3,210 crore rupees. EBITDA at the 9-month mark is almost equal to FY22 EBITDA, and profits at the 9-month FY23 mark is actually better than the profits that they saw in FY22. In terms of the split, most of their revenues coming from the industrial segment at 49%, the automotive segment is 42%, and exports is a small amount at 8% for the company. It is a debt-free company and has been regularly giving dividends to the investors as well, between 18 to 20%, barring FY20, where the dividend payout was really high. Now, what are the triggers for the company? How are they planning to grow the share that they've already seen? And what could the possible risk be? Let's go and speak to the management of the company. And as promised, we are inside the Pune plant of SKF India. The company is completing 100 years. So a lot to talk about, and we'll get you a deep dive into the company's businesses as well. We have with us Mr. Manish Bhatnagar, who is the Managing Director of the company. Mr. Bhatnagar, thank you so much for joining us here on CNBC-TV18. We can't wait to take a deep dive, and the plant is looking fabulous as well. And congratulations on 100 years as well. So before I ask you and talk to you about next, not 100 years maybe, but the next plans for the company, just an industry perspective, I wanted to understand how big is India's bearings market? Are we completely self-sufficient? Do we have to import? And what is SKF's market share here?
So we are about 20% market share. We are about 4,000 odd crores. So you can calculate the market size. The interesting thing about bearings is that 1 in 4 bearings in India is a counterfeit bearing. So the market actually is so much more than that. And the really interesting thing is that customers do not know they're buying a counterfeit bearing. They're really buying what they think is a real bearing. So part of our job is to educate customers and make sure customers get genuine bearings. And because bearings can become a really important component in the machinery, people don't want to buy counterfeits. But to your point, so yeah, we got to manage those imports a little bit better.
Oh yes, so I will get into that as well in the later part of this conversation. You have 2 major segments, so to say, automobiles and industrials. Which is a better or more growing market for you? What are the demand drivers in these 2 segments? When do you say, do you have a cycle here, or is it a steady demand that you see?
So in terms of just diversification of the segments, industrial of course is much more diversified. There are so many segments in industrial: textiles, machinery, railways, energy, etc., etc. Automotive is a little bit less diversified. It's only 4-wheelers and commercial and 2-wheelers, etc. And that's much more dependent on economic cycles. If the price of a car goes up by 5%, consumption drops significantly. And it's tough to make that up in other segments. In industrial, it's a little bit easier. So both are high growth segments, especially in a country like India.
Yeah.
But industrial is more diversified and therefore less cyclical than automotive would be.
Okay, interesting. So you spoke about how these two segments differ. Can you tell us what is demand looking like right now in India generally, especially after we have come back from this post-COVID recovery? And exports, it's a small percentage for you, but is it a high growth market?
Exports is not a big market for us, and that's a very thoughtful strategy.
Okay.
Bearing customers want bearing factories to be as close to them as possible. It's not very efficient to ship bearings from India to Europe or the other way around, unless there are scale issues. So especially on automotive, we need to have bearing factories very close to customers because the scale is there. A channel behind me or a line behind me can spit out 10 million bearings a year very easily. On industrial, because the demand is lower, the batch sizes are smaller, we don't need 10 million bearings a year. It might be 5,000 bearings or 50,000 bearings. So there we may look at exports, but more in terms of consolidation of regional demand.
Okay.
So we can do a factory in India that will supply to India and Southeast Asia. But that's purely a question of scale. If India's scale becomes that large, it will also be more local than exports.
So what is this localization strategy? Earlier you said that you want to increase it by increasing your Capex here. What is the localization percentage? And how are you ensuring higher Capex to ensure higher percentage here?
So Sona, contrary to popular opinion, localization is more than what we make locally in India. It's also localization of supply chain. You know, steel is a big part of what we use. We got to have localized steel suppliers. We have to have localized component suppliers. So when we talk localization, is more than just Capex within SKF. It's how do we support our entire supply chain to become more local.
So what are the localization percentage right now in the automotive and industrial segment?
For automotive, it's about almost close to 90%.
Oh, okay.
Very high.
Yeah.
For reasons I spoke of earlier. On industrial, much lower, about 35-40%.
So the next phase that everyone's talking about is this big electric vehicle boom that's coming through, right? But are less bearings used in electric vehicles? So how can you make this an opportunity? Will it be higher margin or higher volume business?
Yes, you're right. There are marginally less bearings used in electric vehicles. But the kind of bearings changes. They are much more high speed, low noise, much higher quality, better insulation. The kind of bearings change, and they are frankly a higher price bearing sometimes. So we don't really expect our revenue to decline,
Okay.
even though the number of bearings may go down in a few cases.
So how much is EV as a percentage of your overall pie?
It's very small right now, but that's a function of the EV market in
Yes.
India. And it's only a question of when and not if. The EV market is exploding every day. Two-wheelers for sure, four-wheelers to follow. And so as and when that EV market explodes, we are ready.
Okay, so you're ready for whatever demand comes in from the EV
We are
market.
ready. We are ready on our supply side, we are ready on technology side, and on talent side, we are ready.
Okay, so talking more about the EV space, how much higher would the margin be, or if there is a ballpark number? And what is it as a percentage of revenues right now? So you must have done a dipstick survey as well, right? Most of the companies are that EV market will grow by this much. If that happens, how much will you see EV contribution going up for you?
So EV market, again, industry numbers talk about, depending on the segment, about 15 to 20% growth rates over the next few years. Maybe a little more in two-wheelers, a little less in commercial vehicles. If we go by those estimates, we expect our share to also grow in the same range. But I would maybe hazard a guess, we will grow faster than that.
So 20% market share is what you said you have. Can you tell us what are the
That's
plans?
overall.
Overall, of course. What's the plan to grow that? What is the market share that you're aiming, say, 5 years down the line, and what are you doing for that?
I think it's tough to pin a number to it, of course. But certainly we want to grow higher than the market. If the market's growing at 10%, we want to grow at 15%. If the market's growing at 20%, we want to grow higher. What that share will look like in the future, we don't know.
Okay.
But I would hazard a guess in the mid-20s.
The other segment that I wanted to speak to you about is the aftermarket opportunity. That is where you have introduced a lot of products. So, what is the opportunity here for you, the size, and are you looking at more product initiation or introduction in this segment? What's the percentage here right now?
The aftermarket has different dynamics if it's automotive or industrial. Automotive is a function of reach. So how quickly, how efficiently can you have our bearings reach the mechanics where customers walk into? On the industrial side, it's reach, of course, it's also about efficiency. It's also about quality. It's a lot to do with performance. So the dynamics are a little different in both the segments, but both are extremely important parts of our business. And you're right, we have to grow both.
Okay, so how much has it grown by so far? Is it a big market for you in terms of percentage?
It's about half the business in both industrial and automotive. Half the business is aftermarket.
So how will you ensure that a person knows that this is SKF and this is not a counterfeit? How do you ensure that?
Yeah, so we have QR codes on packaging, QR codes on products. Customers are being educated all the time. They can scan the code and they can very quickly figure out if this is genuine SKF or not. Even then, if they're unsure, they can call us.
Okay.
And we'll send someone to their factory and test it for them and tell them.
Okay.
Because customers always want to use genuine products.
I'm sure, why not, right? So when you're talking about growth, earlier you had mentioned that Capex is something that you're planning to increase as well, say by 35 to 40%. Where will it be used? How are you planning to fund it as well?
Well, we are a cash positive company, to say it mildly. So it's all funded from internal accruals. Our Capex typically is about 150 odd crores a year. I think it might go up in the coming years because we're localizing more and more. The channel you stand in right now is only a few months old. So
Okay.
it looks pretty brand new, right?
It does.
Right. And I think we want to have more such localizations in play across all our factories in India.
Okay. So when you talk about localization, does it come with a cost benefit as well? It would be, right? So have you been able to quantify that? Apart from the fact that you want to localize and support the local community as well, there must be a financial benefit to that as well. Has there been any calculation, so to say, how much will margins increase by because of that?
Well, a couple of things. One is, of course, when you localize, you do not spend your cash on importing goods in transit, warehousing, etc. So that working capital gets freed up.
Yeah.
But also, you're also able to get a higher price from customers because customers like localization. Customers don't want disruptions in the supply chain.
So, of course, the chip shortage that we saw, the shortage in terms of supply chain has made a shift in terms of supply chain as well. Is that not a problem anymore with respect to supply chains across the industry and for you?
No, it's still a problem. The supply chain disruptions are here to stay. You know, we've spent too much time in globalizing supply chains. That's going away now. We're getting into more nearshoring, more localization. So that's a structural shift that will stay for a long, long time to come.
So, you spoke about working capital, how that gets freed up a little if you localize more. How does the working capital really work here? You have seen a decrease in your working capital days, inventory days, receivable days. Is all that in place? Will you see a further decline from the current levels? 109 days is what your receivable days are right now.
Again, the more we localize, frankly, the more cash we free up because we're not stocking up our cash on goods in transit, on warehousing, on inventory, etc. We can actually make bearings today and supply tomorrow to our customers versus importing them 3 months in advance. So the more we localize, the better it is for working capital, of course.
Okay. So how much of an improvement are you looking at if there are any projections made in working capital? And are the collections or the receivables in place, like there is no issue with that respect to industry?
Receivables, frankly, has never been a problem for us. We are performing really well on that metric for a number of years to come. So I don't worry too much about that. On the inventory side, absolutely. We expect to cut our inventory costs by about 20-30% if you're able to localize well.
Oh, okay. 25-30% is a big number
On
there.
inventory.
Yes, on inventory, of course. The next thing that I wanted to check with you and ask you about as well, how does it work, is the rotating equipment performance or REP, 5 to 7%. But the idea is that it could be a big opportunity, high margin segment for you. How does it work and how will you scale it up? By how much will you scale it up?
If you allow me to give you a story.
Yeah.
And a customer wakes up in the morning, they think, how can I buy less bearings today? When our sales guy wake up in the morning, they think about how can we sell more bearings today. So there's an inherent conflict between the customers and us. What REP does is manage that conflict and align both the customer and us on the same page. And therefore, we should stop talking about buying less bearings or selling more bearings. How can we align our services to their performance? So let's talk about, can we guarantee you a certain uptime? Can we reduce your MTBF? Doesn't matter what bearings you buy. And that's REP. It's equipment performance.
Okay.
We think in the next 3 or 4 years, it could be double digit for our business. And
Okay.
of course, with much higher margins.
So, Mr. Bhatnagar, we have spoken about whole host of issues, whole host of opportunities for the company and what they are really doing here. What does it mean in terms of growth for you, say for next 5 to 6 years? It's not a short-term thing that we do on this show as well. 18 to 20% has been the growth rate in the last 10 years. What are you planning in terms of revenues for the next 10 years or 5 years?
I think at the very minimum, we want to keep those growth rates alive. But more importantly, we want to grow faster than the market. And not just incrementally faster, but much more faster. And that's how you gain share. So really our aim is to get to as high a share as possible.
In terms of dividend, one thing that the investors like about the company is that you continuously pay dividend and you've been doing that at higher rates. Will that increase going forward or will you look at some other strategy to pay out the shareholders?
Well, we will keep our cash in the company has never been a problem. It's only a question of what do we do with the cash and the multiple options you mentioned. Of course, paying a dividend, investing more, or doing both. And ideally, we want to reward our investors, of course, and we also want to grow the company. But everything will happen from internal accruals. Dividends will be at the same pace as has been in the past. No change in that.
Okay.
Investments, we think, will become more.
Thank you so much, Mr. Bhatnagar. It was a pleasure speaking with you
Likewise.
and being here as well to understand more about SKF India as well. Thank you so much for tuning into CNBC-TV18.
All right, that was a deep dive in SKF. But time to slip into a short break. We'll come back with another interesting stock. Vesuvius India is the stock on our Swotlight segment. Don't go anywhere. Welcome back. You're tuned in to Inside Out here on CNBC-TV18. And as promised, let's turn our attention to our Swotlight segment. Well, Vesuvius India is a stock in focus which has done well in the past 1 year and outperformed its peer group. But before we tell you about the company, let's give you a brief understanding about the industry which it belongs to. That's the refractory market, which is a 20 billion euro market globally, with RHI, Magnesita, as well as Vesuvius having close to around a fourth of the market. Remember, it's largely dominated by medium and small Chinese companies. The refractory market is approximately $1.5 billion here in India, with RHI's market share at around 30%. That's following the Dalmia OCL as well as high-tech acquisitions, while Vesuvius is at around 13%. Looking at the graph, well, you can derive that the top 6 players, well, they account for close to around 70% of the market. Now, since India is expected to be one of the top 3 economic powers in the world over the next 5 years, the refractory industry is expected to see traction, driven by end markets of construction, autos, machinery, consumer goods, and energy. But it finds bulk of its application in steel, as it is a specialized ceramic which can withstand temperatures of more than 1600, which are used to control molten metal flow in the steel industry. The refractory industry, well, it can be said it's a proxy to the steel industry, whose capacity is targeted to double to around 300 million tons by 2030 here in India. Additionally, from sectors where it has exposure, it's just around 0.5% to around 3% of the customer's cost. The India refractories market growth is forecasted at a CAGR of around 6% between 2023 and 2025. There is also an opportunity to increase exports from India as India becomes a manufacturing hub. Well, in terms of numbers, the street was a little bit disappointed with the company's December quarter results. There was a mild degrowth on the top line. But the bigger problem was the disappointment on the margins, which got compressed due to higher input cost, inferior product mix, and also could be due to the year-end phenomena for the company. In the past 4 years, if you pull up the yearly chart, well, the revenues have grown at a CAGR of around 10%, with average margins in low teens. Now, on the valuation front, it trades at a bit of a discount to RHI Magnesita, but at a premium to its smaller peer, that's IFGL Refractories. Well, let's run you through why some part of the street believes that it's calling for premium multiples. The company has solid parentage as it's an MNC. It also has a clean balance sheet with cash of around 550 crores. That equates to around 18% of the current market cap. In terms of return ratios, its ROCE is around 13%. But if you adjust it for the cash in its book, the core ROCE is close to around 30%. And finally, in February 2023, well, the management announced a mega 500 crore investment over the next 3 to around 5 years. That's what could meaningfully result in a surge in revenues in the years to come, basically giving you revenue visibility. Remember, as of now, the company generates close to around 130 crores of EBIT on the last reported gross block of around 250 crores. Well, let's wind this down then with the shareholding pattern. There are some marquee funds that hold stake in the company, and as this graph tells you, majority of the stake is held by the promoter entity. Well, we've run out of time on this edition of Inside Out. It's goodbye from Sonal and myself, but do write to us and tell us the companies you want us to discuss and want to hear about. We'll try to feature them on our show. Thanks so much for watching.